John O'Donnell from Reuters. One of the big lessons from the financial crisis was that there would be no more public bailouts of banks, and also that banks that were too big to fail wouldn't be created. And yet the decision today creates a bank which is even bigger than any bank which has ever existed before in Switzerland. And also the vast majority of the cost of this bailout is borne by the state and the Swiss taxpayer. Could you comment maybe on that, and also perhaps about the division of cost between private investors and the Swiss taxpayer?
Well, I don't know if the question goes to me. I mean, I have to state that very clearly. This is no bailout. This is a commercial solution because we have a takeover of UBS. Well, UBS is taking over Credit Suisse. So this is a commercial solution and not a bailout. We really wanted to avoid a bailout for different reasons. But I just maybe come back to the question of the too big to fail framework. I mean, the too big to fail framework couldn't have been applied here really, because usually, you know, this is applied to a bank that cannot meet its liabilities anymore. And here we had a problem of liquidity. So it is not typical at all, you know. And as I stated in my introduction, also the bankruptcy, you know, the bankruptcy of Credit Suisse would have had a collateral damage, a huge collateral damage on the Swiss financial market, also risk of contagion for UBS and other banks, and also internationally. So I was in contact with my colleagues from UK and USA. They're very grateful for this solution because they really feared that there could be a bankruptcy of Credit Suisse with all the losses. And you know, the taxpayer in this scenario has less risk. I mean, the bankruptcy would have been the highest risk because the cost of the economy would have been huge, the Swiss economy. Then I would say that any other scenario that could have been imagined in the too big to fail scenario would also have had more costs than if you have a private partner, a bank, a solid bank that says we take over Credit Suisse. What we do is something that is, you know, the governor of the central bank pointed it out, is a instrument that is well known in other jurisdictions like the UK or the US, which is the PLB, which is a guarantee to the central bank. It's not money we give to Credit Suisse or UBS. So we find that this solution is the best solution, and I hope it will also be welcomed by other jurisdictions.
Madame Amstad et Monsieur Jordan veulent compléter. Madame Amstad.
Well, this is not a classical too big to fail situation where we have where solvency takes a hit, and then we'll have to not only to trigger the 81 but also the bail-in bonds. This really is a crisis of confidence, and so that's also why the solution is not the classical too big to fail solution, but we have decided that this solution between the takeover of Credit Suisse by UBS is more appropriate. And yes, of course, now we have an even bigger bank. And in the too big to fail framework, exactly for this situation, we already have requirements and rules. And those rules will apply. They will apply after some transition phase. And this will mean that the capital and liquidity requirements for this bigger bank will be proportionally increased.